Hey, what's up, guys? Paco here, and welcome back to a new episode of Trading with Paco. It's been Christmas 2 days ago, so I wanted to wish all of you guys Merry Christmas and thanks for the support that you're showing to this series and to my channel. I really appreciate it. Today, I decided to go back to what I think is the core of my series because I called it Trading with Paco, but I feel like I haven't talked about trading for a while. So today I prepared a video on trading method, swing trading. But before we get into it, remember to drop a like on the video if you enjoy it, subscribe to my channel for weekly content, and of course turn on notification because even during the holidays I will keep dropping video every Sunday. But without further ado, let's get right into it. So, what is swing trading? Well, swing trading is a trading method, of course, that attempts to capture short to medium term gains in a stock. This is according to Investopedia. But how do you do this? So, you use a technical analysis, which is more simply observing the price movement of a stock in the past, to look for trading opportunities and capitalize on them to a short to medium time frame. So, in simple words, swing trading involves taking trades that last from a couple of days to even a couple of months, 8 weeks, in order to make profit on an anticipated price move. So you want to project where a stock might be in a few months, buy now and then sell when it rises. Something important to notice though is that swing traders, something that day traders are exposed to, are exposed to overnight and weekend risk. As we know, overnight the market closes. And so when it opens again, the prices could be different. This risk is something that day traders avoid by buying and selling in the same trading session. But swing traders can't because they want to capitalize on a longer period of time. So they have to expose themselves to this risk. Successful swing traders only look to capture a chunk of the expected price move and then directly move on to the next stock. What does this mean? Very often, swing traders don't sell when the stock reaches its highest price. They sell earlier because they want to move on to the next opportunity. Also, keeping a stock until it reaches its peak could be a risk which swing traders don't want to get involved into, so they sell earlier. Some may say that they don't maximize on profit, but by doing this, you can always move on to new opportunities, meaning that eventually you will get the profits. So some traders like to use swing trader on very volatile stocks with a lot of movement, which maybe you would only keep that stock for a few days, while others may prefer more steady stocks, where you might want to keep the stock from 6 to 8 weeks. Anyways, swing trading is simply identifying where a general asset will move next, then enter, and then just capture a chunk of the profit when it eventually materializes. You do not want to risk keeping it until it reaches its peak because you might miss it and eventually lose. So as I said earlier, for the swing trading, it's very important to assess their stocks carefully and find out which one will actually be the most profitable. So what method do they use? Well, they use what I like to call the risk-reward ratio. So let's say that, for example, I am risking €1 per share, and these shares have the potential, after all my research and calculation, to give me a €3 gain. Well, this is of course a very favorable risk-reward ratio because you can make a significant profit on every share. But let's say, for example, that another share which I invest €1 on might actually only give me €1 in profit or even less, 75 cents. Well, this of course isn't quite as favorable as a risk-reward ratio because you're exposing yourself to risk to make a very small profit, which is of course not as convenient. For a swing trader, it's very important to carefully research and understand the risk-reward ratio for every share because, as I said, a swing trader only wants to capture a chunk of a potential price move. You do not want to wait until it reaches its peak because that would just be too risky and the method wouldn't work, of course. So you need to, since you will have many shares and stocks and other different commodities, you have to choose the ones that can offer you the best potential profit because maybe you will end up investing in one which doesn't have as much potential as another one, another different commodity which could have given you a lot more money. So a few weeks ago, I made an episode on day trading, which is another trading method which has become very popular now, thanks to the many online platforms for trading. But which one is the most convenient out of the two? Well, let's analyze the pros and cons of these two trading methods and see which one is actually the most convenient. So if we look at swing trading, it definitely requires less time than day trading because you might end up actually keeping the specific commodity for a longer time than day trading where you buy and sell in the same day. So of course, day trading is a lot more time consuming. Also, you need a lot less research than day trading for swing trading. Of course, you need to do very specific research, but with day trading, you are risking more, meaning that you need to be even more specific than swing trading, where you can only rely on technical analysis. Swing trading does have some drawbacks though. One of them being the overnight and weekend market risk, where the market closes, of course. So when it opens again, the prices of the commodities that you bought might be very different to what you expected, meaning that you could lose money. Also, the market in this period of time where you keep the commodity might have there might be a crisis. This might seem very unlikely, but for example, let's say that I bought many commodities in February 2020 and I wanted to sell them after 2 months, which is a average period of time for swing trading. So I would have to sell in March, April. There has been the COVID-19 crisis, meaning that my investment will be a complete flop because of this crisis. And this is another risk that you have to take with swing trading. Lastly, swing trader often miss long-term potential because they want to capitalize in a shorter period of time. An example could be a swing trader selling their commodities after 1 or 2 months. Well, if per se he kept them for a year, they would have made a lot more money than what he actually did. This is another risk that is involved in swing trading because of course there's the other risk that maybe if you keep a commodity for a very long period of time, it will eventually drop in price and you will lose money. Before we end, I would really recommend you guys to go watch my day trading video because I cover that method completely there, and it could be very useful even to help you understand this new video where we compare these two methods. That being said, we have come to the end of today's video. I hope that you enjoyed it. If you did, drop a like, drop a comment, giving me any feedback if you like this type of video, if you want me to cover history more trading. I'm always open for feedback and I always appreciate it. So comment down below. Subscribe if you haven't already, and as I said, turn on the notification bell. But most importantly, enjoy your holiday because the next time we're gonna see each other is gonna be a new year, hopefully better than the past one. Not only for traders, but I think for everyone around the world. So best wishes for 2021. Thanks for watching. See you next time. Bye bye.